Hello everyone. Today I would like to present to you guys about chapter 9, which is banking regulation and management. My name is Ahmad Zaim, and our first topic is about concept of capital. What is capital? Bank capital is the final category of liabilities side of bank balance sheet. Capital provides protection for depositors and other creditors in the event assets decline in value or financial institutions suffer loss. Minimum capital is required by a banking institution such as commercial and investment bank in order to operate as a going concern entity. What is considered as capital? Preferred stock and equity of share capital, reserves, loss reserve, and lastly, equity capital such as capital stock, surplus, undivided profit. What is the importance of capital? Firstly, capital provides the need fund to charter, organize, and operate a financial firm before deposit and other source funds come in. Secondly, capital provides a cushion and protection against operating and financial loss. After that, capital also promotes public confidence, reassuring creditors and borrowers. It also ensures adequate capital to gain investors' confidence and more easily to absorb potential loss and more likely to survive. Next, capital also provides fund for the firm growth and development of new products and services. Lastly, importance of capital is for serve as a regulator of growth. Capital can ensure growth is sustainable in the long run. Concept of capital adequacy. Definition of capital adequacy. Any level of capital that allows a bank to absorb or accommodate any loss and at the same time equips the bank with sufficient funds to sustain and carry on its business as a continuing entity. Meanwhile, capital inadequacy is the main factor of bank failure and closure. Capital adequacy requirement. A feature of bank supervision since 1986 that required owners of authorized deposit-taking institutions to invest a certain percent of capital adequacy ratio. Applicable to all licensed banks, it also requires central banks adopt a framework for determining uniform capital requirement that is based on the bank's risk level since Basel I 1988. Capital adequacy ratio equal to capital fund net of fixed and long-term investment over total asset net of fixed and long-term investment. That's how you get capital adequacy ratio. Okay, now let's go for risk-based capital approach or capital risk asset ratio. There are 5 categories, which is 0% category, 10% category, 20% category, next is 50% category, and lastly is 100% category. For first category, which is 0%, it consists of assets with zero or low credit risk. Cash claims on the government of Malaysia, the Organization for Economic Cooperation and Malaysia Development (OECD). Next is 10% category. It claims on Discount House and Cakamas Berhad. 20% category claims guarantees of financial institution in Malaysia. It also claims on domestic development banks such as Agrobank, MIDF, MBSB, and it also claims on OECD banks. Next is 50% category. For this category, loans secured by mortgage on residential properties, secured by first charge on a property. Last category is 100% category. All other assets include claims on the non-bank private sector, commercial companies owned by public sector, non-OECD banks, with a residual maturity of over 1 year and investment in shares. What is risk-based capital approach? This risk-based capital approach looks at asset in terms of riskiness rather than simply looking at total asset. It is act as a cushion against financial loss. The higher the CAR, the better. What's the mean by the word the better here? It means it shows the financial strength. Risk-based capital approach requirement would be a percent of that risk-weighted asset base. Example, must maintain minimum of 8% ratio of capital to total risk-weighted asset. Okay guys, remember this. Minimum capital adequacy ratio CAR equal to 8%. 8% is the minimum capital adequacy. Okay, in the Basel Accord 1988, the central banks of 12 major countries agreed to uniform capital requirements, facilitated by the Bank of International Settlement (BIS), based in Basel, Switzerland. Key change made by the Basel Accord: to base the capital requirement on a bank risk level, force banks with greater risk to maintain high level of capital, discourage banks from excessive exposure to credit risk. What are the assets are weighted according to risk? Example are very safe assets such as cash are assigned a 0% weight. Very risky assets are assigned 100% weight. Since the required capital is set as a percent of risk-weighted assets, riskier banks are subject to more stringent capital requirements. Let's go for Basel II Accord. It implemented in 2007. Okay, Basel Committee have been working on a new accord for Basel II. It refined risk measures and also increased transparency of a bank risk to its customers. Three major parts of Basel Accord. The first part is revised measurement of credit risk. Banks can continue to use traditional approach to calculate credit risk, such as categorized asset and assign risk weight to the categories. Bank loans that are past due will be assigned of 100% of it. Banks with past due have to maintain larger amount of capital. The second major part of Basel II Accord, which is implicitly account for operational risk. Operational risk is risk of loss resulting from inadequate or failed internal process or systems. By imposing higher capital requirement on banks with higher operational risk, Basel II provides incentive for banks to reduce their risk. The last major part of Basel II Accord is require more disclosure for market participants. Banks are required to provide more information to existing and prospective shareholders about their exposures to different types of risks. Roles of Basel Accord. It is to promote safety and soundness in the financial system. Basel Accord continues to enhance competitive equality. It also constitutes a more comprehensive approach to address risk. Next, Basel Accord also render capital adequacy more risk sensitive. And the last role of Basel Accord is to provide incentives for banks to enhance their risk measurement capabilities. Okay everyone, now I will continue about liquidity management. What is liquidity? Liquidity is able to meet deposit withdrawals and to fund loan demands. Liquidity able to accommodate decrease in liability and to fund increase in asset. That's the meaning of liquidity. How about liquidity management? Liquidity management is a process of generating funds to meet contractual or relationship obligation at a reasonable price at all times. Example of liquid asset. First is cash balance. Second, money at call. Then investment in government papers and deposit with other bank. These are the example of liquid asset. Role of liquidity management. The first role is to ensure sufficient funds available at a reasonable cost to meet potential demands of funds from depositors and borrowers. The next role is to manage liquidity, as some banks' liabilities are of shorter term than their asset. In order to remain liquid, banks are required to maintain reserve requirement. First is primary reserve requirement, which is cash. Second is secondary reserve requirement, which is securities. For secondary reserve requirement, it can be converted to cash quickly with little or no loss in value. Must be maintained at least 17% of the eligible liabilities as liquid asset requirement with Bank Negara Malaysia. Examples of secondary reserve requirement: T-bills, short-term debt securities, bankers' acceptance. What are the source of liquidity? The first source is new deposit from customer. Next is interbank borrowing, collateral liquidation, maturing asset used for reinvestment or to meet withdrawal demand. And the last source of liquidity is discount window. What is discount window? You can borrow from B&M, being used infrequently to meet unanticipated liquidity demand. Indicators of bank facing liquidity risk: a decline in indicators of asset quality. Next is a decline in earning or profit. Overall funding cost increase, required collateral for accepting credit exposure to the bank. Next, drop in bank shares price. Another risk are downgrades of credit rating by rating agencies, customers contacting bank requesting info, and rumors are trouble bank. This shows bank facing liquidity risks. Next, we will go for ALCO, which is Asset and Liability Management. ALCO is a committee that manages a bank's assets and liabilities to balance its risk exposure and to achieve its operating objectives. Components of a bank balance sheet. For asset and liabilities. For asset balance sheet, there are cash, short-term securities, long-term securities, short-term loans, and long-term loans. For liabilities, balance sheet have deposit account, borrowing, bank capital, reserve, and surplus. What is the function of ALCO? It is to detect and measure possibility of various liquidity shocks. It is to ensure adequate and low-cost source of funding are available. ALCO also can assess market risk and position the bank. It is to handle the interest rate scenarios at minimum cost while still achieving a reasonable level of profitability. Consideration in ALCO. First is profitability. Mix of assets and liabilities must earn from assets are sufficient to cover interest expenses and other costs on liability in order to generate profit. Secondly is liquidity, able to meet any deposit withdrawal and maintain public confidence. After that, consideration in LCO is about risk. Risk of reducing value of its asset. It will cost reducing capital value. Flexibility also a consideration in ALCO. Ability to respond to changing conditions or anticipate change in the form of either problems or opportunity. The last consideration in ALCO is regulatory requirement. It is to encourage safety and liquidity. It is to promote an accomplishment of public policy goals. Now, I will pass this presentation to Muhammad Hisyamuddin.
Hi, I will be explaining about asset quality. Asset quality refers to market value of the asset and adequacy of provision against asset losses. Loan is an important asset as it contributes larger sources of income to a bank, for example, like interest income. Loans and advances are serviced by borrowers according to loan agreements. If the loans are not being paid for 3 consecutive months, it is classified as non-performing loan or NPL. We can measure a bad loan by using NPL ratio. The loan approval should be granted upon detailed loan or credit evaluation processes. A perfectly sound credit evaluation can be negated by poor loan documentation, poor monitoring of loan account, and ineffective collection procedure. So, what is bank credit process? There are 4 stages. First is business development and marketing. Second is credit evaluation or analysis. Stage 3 is loan administration or monitoring. And lastly, stage 4 is loan recovery or remedial management. Banks can reduce NPL by performing prudent banking in giving out loans, such as checking credibility of potential borrowers via tedious analysis in the credit evaluation process. Next is sufficient collateral or security, and lastly, sufficient guarantee. For credit evaluation process, there are 5 C's that we need to know. First is character. Track the potential borrower's reputation and previous records of paying debts to evaluate their willingness to pay when the loan is due. Next is check their background, their working experience, personal credit history, knowledge, education, and skill. Next is capacity. Evaluate the borrower in terms of their legal status to enter into a contract to ensure they have legal standing to sign a binding loan agreement by ensuring their company is incorporated by laws under Company Act 2016. Next is the customer has reached the age of majority. Commonly, minor cannot be held responsible legally for loan agreement. Thus, bank may have difficulty to collect the debt. Third is capital, the amount of money invested into a business by the owner of a firm. Owner of a firm must have his own funds invested before a bank is willing to take risks in their investment. The amount contributed reflects the commitment and the risk the owner of the company bears. Number 4 is condition. Bank evaluate the current market and economic condition, industry outlook, government policy, and regulations that affect the business performance and the credit environment. Bank 2 analyze the industry a company is operating and the current condition of the entire industry. Lastly, number 5 is collateral. Collateral refers to assets which may be charged or pledged to the bank as security for the loans, used as the secondary source of repayment of the loan if the firm fails to repay the loan. For example, like account receivable and inventory. Now, let's move to detection of problem loan. From operations of the account, we can detect a problem if the balance sheet shows a slowdown in receivable collection period, decrease in inventory turnover, or substantial increases in long-term debt. If it is under income statement, we can see a sales decline and profit decrease or sales increase and profit reduce. Large increases in overhead relative to cost or suffer operating or net loss. And if it is under bank account statements, there is a declining bank balances, heavy reliance on overdraft, borrower issue post-dated checks to customer, or existence of dishonored checks. Next is how to detect a problem loan from the operations of the business. First is a reducing profit trend and decreasing profit margins, no business expansion opportunity. Second is change of key personnel or change of ownership. Third is poor financial records and operating control. And lastly, poor maintenance of plant and equipment. And lastly, on how to detect a problem loan from the threats in the changing environment. First is in the adverse economic conditions, recession or high inflation. Second, changes in government regulations and policies. Third, a catastrophic events, for example like storm, fire, flood. And next is change in taste and preference of public. And lastly, changes in technology bring to innovative products and high competition.
Hello, my name is Mierzad bin Mohtar, and I'm about to present for the next subtopic for this chapter. The next one is loan recovery technique and procedure. There are 5 stages of loan recovery. Stage 1, cooperative workout agreement. Stage 2, collateral liquidation. Stage 3, reducing debt to judgment. Stage 4, enforcement and collecting of judgment. And stage 5 is bankruptcy. So for stage 1, cooperative workout agreement, bank try to help out borrowers through negotiation. Second, suggest cooperative workout agreement, non-legal agreement where a plan is designed for new repayment arrangement. The third one is modify terms of loan agreement by lengthening duration of agreement, restructure the loan amortization schedule to include the deferred P plus I due. Okay, so let's continue. The fourth one is liquidating assets of borrowers. Number 5, request additional collateral or guarantors. The sixth is forcing borrowers to collect all credit sales and tightening the terms on credit sales. And the last one is restrict borrowers' activities, such as investing in new equipment or expanding a plant. So stage 2, collateral liquidation. It is a process of converting charged securities into cash to repay the outstanding P plus I due. Proceed used to settle debts with bank. Remaining balance will return to borrower. If is insufficient, borrower tops up. Stage 3, reducing debt to judgment. Take legal proceeding on problem loan borrower or guarantor to pay off the debts. A judgment is a legal document obtained through the process of court order that confirm the obligations and claims of parties to the loan. Amount of bank's legal claims, amount of P plus I due, interest during foreclosure proceeding, court costs and legal fees. So continue. Bank must pursue post-judgment discovery and attach a list of borrowers or guarantors' income or assets. Investigate source of income and types of asset available from borrower or guarantor. Decides techniques used to collect debts. Next is stage 4, enforcement and collecting of judgment. The first one is levy, outright seizure of a property. Seized assets are sold at a public auction, proceeds used to settle the debt and other legal claims. Second is garnishment. Third party owing to borrower to repay the debts to the bank. Require court order to instruct third party to forward the fund to the bank. Applicable to the guarantor. Individual garnishment of salaries. Business borrower. Garnishee order on payments of tenders, contract or sale of assets from third party. The third one is equity receivership. Court supervision. Court may appoint a receiver to take control of borrower's asset. Receiver get as much as possible out of the business to pay the bank and other creditors. Follow with an orderly liquidation and distribution of the proceeds to the bank and the creditors. Applicable to guarantor if borrower is insolvent. The fourth one is public sale. Forced liquidation of collateral by banks through legal action against the borrower. When market value of the security charged as collateral is higher than the amount of debt owed to the bank. Bank apply court order to sell the charged asset to the public. So this is the last stage, which is stage 5, bankruptcy. Apply court order for bankruptcy to provide for the orderly repayment of debts without debilitating a borrower. Court appoints creditor committee recommendations on settlement of the debts. Appoint trustee to take care of borrower's asset which will then be liquidated and the proceeds will be used to pay debts. So there are two types of bankruptcy. The first one is voluntary bankruptcy. Borrower voluntarily files a petition for bankruptcy. Second, involuntary bankruptcy. Borrower is forced into bankruptcy by his creditors requesting a settlement of the debt through litigation. Next is performance evaluation of a bank. The first one is true earning capacities of assets and profitability of financial institutions. Second, take account interest paid or earned and provision on non-performing loan (NPL). And the third one is by looking at the items in the income statements and the relevant ratios. Next is bank performance, which is profit and loss bank statement. First, gross interest income minus gross interest expenses equal net interest income plus non-interest income minus loan loss provision minus non-interest expenses plus minus securities gain or losses equal income before taxes minus taxes equal net income minus cash dividend provided equal retained earning. The next one is income statement items. There are several items, which is the first one is gross interest income. Interest income generated from all assets. Second, gross interest expenses. Interest paid on deposits and on other borrowed funds. Third one is non-interest income. Fees charged on service provided. In example, safety box services, BA checks, forex transaction. The fourth one is loan loss provision, reserve account established by bank in anticipation of loan losses in the future. The fifth one is non-interest expenses, salaries, office equipment, and other expenses not related to the payment of interest on deposits. And the last one is securities gains and losses, result from bank sales of securities. Next is bank performance evaluation. The first one is identify the items in bank's financial statement, income statement, and balance sheet. Second, calculate the financial ratio. The third one is comparing the ratio or income statement items as a percentage of total assets to an industry benchmark of previous year's performance. So let's continue. If bank's net interest margin is relatively low, it is either is relying too heavily on deposits with higher interest rate or is not earning adequate interest on its loan. Second, if the bank is forced to boost loan loss reserves, their loan portfolio may be too risky. If its non-interest income is relatively low, it may not providing enough services that generate fee income. If bank's non-interest expenses is relatively high, cost of operation is excessive. Next is how to evaluate bank's performance. It is by analyzing financial statements through ratio. There are many types of ratio, which is the first one is profitability, return on asset, return on equity, and interest spread. Second one is liquidity ratio, which is loan to total asset. The third one is capital adequacy ratio, which is risk-weighted capital ratio and core capital ratio. The fourth one is asset quality ratio, which is non-performing loan ratio and loan to deposit. So profitability, it measures use of bank's asset and control of its expenses to generate acceptable rate of return, how much return from the equities invested by the banks, how much return generated from the assets held by the banks. So for profitability ratio, return on equity, which is ROE, formula is net income divided total equity times by 100. Measure how much profit the bank generates with the money shareholders have invested. If ROE increases, investors will be attracted to invest more. Second is ROA, which is return on asset. Measure the efficiency of management in using its asset to generate earnings. Formula: net income divided by total asset times by 100. The third one is profit margin. Formula: net income divided by operating revenue times by 100. It measures amount of net profit earned from its operating revenue. And the fourth one is asset utilization or asset turnover ratio. Formula: operating revenue divided by total asset. Measure bank's efficiency in utilizing its asset. So let's continue. The next one is net interest margin, NIM. Formula: total interest income minus total interest expenses divided by average earning asset. Next one is provision for loss ratio. Formula: provision for loan losses divided by total loans and leases times by 100. If this ratio is high, it indicates high risk position of the bank. The next one is equity capital ratio. Formula is equity divided by total asset. The next one is spread. Formula: interest income minus interest paid divided by total asset. It measures true cost of intermediation. The next one is net gearing. Formula: net debt divided by equity. It measures financial leverage. Next is liquidity ratio. It measures ability of a bank to meet cash obligations when it is needed. It measures availability of cash. Ratio: current ratio or working capital ratio equal current assets divided by current liabilities. Measure bank's ability in paying short-term and long-term obligations. Investment maturing in less than 1 year to total assets. If this ratio increases over time, bank has more liquid asset. So let's continue. Ratio: loans to total assets. Loans are illiquid assets, cannot be sold until its maturity. If this ratio increases over time, banks have more non-liquid assets but able to generate more profit. Next is purchase liabilities to total assets. Purchase liabilities equal to hot money, mature very quickly. Normally, financial interest plan to sell new short-term securities to replace maturing securities. If this ratio increases over time, bank has increases its proportion of assets, but it shows a decline in liquidity. Next is asset quality. Ratio of non-performing loan to total loans, GNPA. GNPA, gross non-performing loans to gross advances ratio. High GNPA shows poor credit decision making. Next is credit quality. Not all loans are good. Might be case of defaults on loans. Some are bad debts. Bank must anticipate certain percentage of loss rate on consumers' loan bad debts. If it is not anticipated, bank's income will be affected. Ratios to measure credit quality, credit loss provision to total assets, credit loss coverage equal to earnings before tax plus provision for credit losses divided by provision for credit losses. Credit loss coverage measures the margin for error provided by income. High credit loss ratio means greater margin per error, safer for the banks. And the last one is capital adequacy ratio, also known as capital to risk-weighted asset ratio, ratio of a bank's capital to its risk. Measure whether the capital is adequate or not for the banks. Provide protection for depositors and creditors in the event that assets decline or banks suffer losses. Formula to measure capital adequacy is equal capital divided by total asset.